Hello, welcome to the Bitcoin Standard podcast. Our guest today is Nik Bhatia. Nik is the founder of the Bitcoin Layer, a Bitcoin and global macro research firm, and the author of the best-selling book, Layered Money. Nik joins us today to discuss his new book, Bitcoin Age, in which he discusses the development of Bitcoin and the fiat credit system over the years and how he expects this to play out into the future. We've had Nik before here to discuss his previous book, Layered Money, and it's always a pleasure to be talking to him. So thanks for joining us, Nik.
Safe, great to see you, my friend. How are you?
I am very good. So congratulations on getting your book done.
Thank you. I'm just trying to keep your pace.
This is your second, right?
It is.
You gotta up those numbers, man. Nah, I mean, I could totally relate the pleasure of the week after it's out, and you no longer have to worry about it and stress about it. It's a very nice feeling. So congratulations on that.
Thank you.
You mentioned you're going to be traveling now to enjoy some time with the family.
Yes, we're heading out of town next week and a couple trips throughout the year. So it'll be nice to take a little bit of time away from the intensive writing of a book.
Fantastic. Great. All right. So, what is this book about? And tell us about it and how it follows from your previous book, which we discussed in the last time you joined us.
Yeah, so Layered Money, my previous book, was an outline for a framework to understand money. And that framework is based off of hierarchy. That's where the layers come from. That exploration was it was actually an accounting phenomenon, and it was an exploration of how money is structured from an accounting perspective. Why gold, deposits, Bitcoin, currency, they actually have a layering or a hierarchy to them. So the book was, to be honest, it was quite academic in its nature, but I wanted to introduce Bitcoin from an academic perspective. In this book, Bitcoin Age, I tell the story of Bitcoin. And it is my personal story of how I view Bitcoin's history and origin, right? So everybody has their own interpretation of Bitcoin and where it came from and why it is here and why it is so popular, right? We know it's popular because it has 2 trillion in market value over the course of 16 years and several cycles up and down. The proof is in the pudding in terms of Bitcoin's popularity across the world. So I wanted to tell the story of Bitcoin from my perspective. So I read everything I could about the history of the internet, the history of cryptography, and the history of banking, so that I could concisely tell what I think is an intersection of banking, the internet, and cryptography. And so I tell that origin story, and then I get into the first days of Bitcoin and tell the 16 years of Bitcoin's history as well from my lens, and why I think Bitcoin is here to stay, and why I think that Bitcoin and the dollar credit system will continue to coexist for decades in the future. I don't see an immediate Bitcoin becoming the world currency that everyone is using. I see it as a parallel, like you call it in your first book subtitle, the decentralized alternative, right? It is an alternative, and that is part of my thesis.
Yeah, I certainly agree with that one. You begin the book by discussing the evolution of credit, and the whole book centers around the discussion of credit in the fiat monetary system. So, walk us through your thought process there. What is the relevance of credit for Bitcoin? Why does this have to be the motivating topic for a whole book on Bitcoin?
Yes, and I think that understanding the writings of Satoshi Nakamoto, the creator of Bitcoin, is our best source of information as to why Bitcoin was started. And Satoshi had a few comments that he made in the early days, even before Bitcoin software code was released, and then of course, in the coming months after it was released. He identified the fiat system, the expansion of credit, and the application of credit to, or let's just say, the development of credit bubbles. And credit bubbles then create credit crises, which then trigger bailouts. And so in the Genesis block, as I'm sure everyone listening is aware, Satoshi put a headline from a newspaper article about bank bailouts. And so we must take his words for it that credit and the expansion of credit was a driving motivator to create the system that he did, which actually had a scarce supply. So that contrast, and Saif, as you know, you've been writing books about Bitcoin for so many years. If people really understand and identify with that 21 million cap, almost more than anything. So if you can start there to people and just present that contrast of credit expansion versus 21 million, you set the stage for why Bitcoin is demanded. And so I traced the, obviously layered money was about the origins of credit and currency and double entry accounting and fractional reserve banking. But in this book, I decided to start with just the dollar, because the dollar credit system is now a global banking dollar system. It's actually much less a US phenomenon than it ever has been. And so I wanted to trace the origins of the global banking dollar and that credit system with this story, not just credit in general. Because for credit in general, you have to go back and tell thousands of years old stories, which you have done, and I did in Layered Money as well. But I didn't want to do that this time. I wanted to purely just tell the global banking dollar credit system story. And that began, in my judgment, in 1913 with the creation of the Federal Reserve.
Yeah, fun story. You start off with the famous fake duck hunting trip, which happened in a place called Jekyll Island and then gave birth to the Federal Reserve. But before we get into more details than that, I wanted to nitpick on this pet peeve of mine. There's this discussion recently. I think it was the Finnish early Bitcoiner. I think his name is Matti Malmo, something like that. He was one of the earliest people in Bitcoin, and he corresponded with Satoshi, and he just released his correspondences. And it had some discussion about the supply. And it shows that Satoshi initially was thinking about something that would be relatively less designed to go up a lot less than now, that it would have a relatively more stable value over time. That was how he envisioned it. And he was discussing how he's trying to do this and how he could make it so that there could be some way to stabilize the value, but he couldn't think of a way to do that trustlessly. And so he had to end up using a fixed 21 million out of engineering necessity, perhaps not out of economic motivation. And I find this fascinating because, first of all, when I start thinking about Bitcoin as an Austrian economist, I'd like to think that it was some guy who read Rothbard and then sat down in his basement and tried to make Rothbard into a minimum viable product and then introduced this monetary system. And it is tempting to think this is the case because, as a Rothbardian, you want to think that his writings are influential a lot. But it seems to me that he came across it in a way that, while maybe even vindicates Rothbard even more than him just reading Rothbard, because he arrived at it as an engineering solution because he couldn't do it in a way that was trustless. And he had to resort to the only thing that works. And that's the Austrian point. The Austrian point is not so much that it wins academic discussions and debates about what should or should not be money. The point is, money is what works. And so he had to figure out what works. And in order to figure out what works, he stumbled upon the Rothbardian solution to money without necessarily having set out by it. I think, and I discussed this with Aaron von Wierdum when he came on my show, because he discusses this in the Genesis block. And I got his opinion on it, and he said it doesn't, maybe Rothbard, maybe Satoshi was not influenced by Rothbard or the Austrian school directly, but the cypherpunks that he was corresponding with and the software in which he built and all the previous attempts were very heavily influenced by that. So I think there is also an underlying ideological influence that he may not even be aware of, but it's still there nonetheless.
Yes, so you bring up a few excellent points. The first is that we shouldn't necessarily conflate 21 million with the credit system as in terms of one was inspired by the other. So I agree with that. Secondly, when we think about 21 million as an engineering necessity, I think that is very important to identify. Because actually, if you need a decentralized cash system to work, you need a group of incentives that make that network work together. And so 21 million, the supply cap, the difficulty adjustment, proof of work in general, public key cryptography, these are all crucial components to the system. And the system wouldn't work without every one of these components making the game theory work. So I actually agree that the 21 million was an engineering solution more than a response to credit bubbles, let's say, and even to the point where it could be 100% contributed to the engineering side of things, not any Austrian inspiration itself. Now, the Austrian inspiration, or the pure credit inspiration behind Bitcoin, is the decentralized component of it, right? So in order to accomplish this decentralized component, it appears we did need a hard cap to make the game theory work. But I like the nitpick because it's important not to make the connection that the 21 million itself was driven by an awareness of credit bubbles in the past, or trying to make it non-credit like. The nitpick for that argument's sake is that Satoshi mentioned gold lots in his writing as well as the paper itself. And so if we want to think about gold's inspiration for Bitcoin and gold being scarce, then maybe more than an engineering solution, and purely an engineering solution and somewhat inspired by the best example that we have for decentralized money previously, which is gold.
Yeah, although what he was looking to try and replicate with gold was, no, he did mention that the quantity of gold was finite, that we keep digging for it. So yeah, I guess you're right. Yeah, no, I think that's a good point.
But
All right.
it is so amazing to think about the game theory that he designed, because I gently introduced the concept of game theory being, strategic decisions and the science of strategic decisions. And Satoshi definitely had this grasp on that game theory design that clearly no one had been able to do before. I mean, no one had been able to accomplish this, and people had tried for decades.
Yeah, absolutely. Okay, so what is it about Bitcoin that fixes the problems of credit? Why does 21 million fix credit, in your opinion?
So I don't think that it fixes credit. I think that it just provides that perfect alternative to it. And the reason that I don't see a credit system going away or replaced by Bitcoin anytime soon is that the discussion of, or the Credit Extension Act itself is a two-party engagement. There's a borrower that wants to spend now, that can't afford to spend now, that wants to spend now. There's a lender that is motivated by profit. So if someone with a good income comes to a bank and wants to buy a house, the bank can see potential profit in that loan on a longer term time horizon. Today, they don't even have to necessarily wait. They can just package that loan with other loans and resell it and make their profit instantly. As the ultimate bearer of the debt goes into the shadow banking system as opposed to pure deposit lending. So if there's a borrower willing to spend now that can't afford it today, that has a good job, and a bank willing to make that loan, how does that system of credit expansion stop or go away under our current banking laws? I don't see that system stopping. Also, the extension of credit through fixed income securities is heavily dependent on that banking system that allows money printing from commercial banks when they just issue deposits, right? So if how it works is that, forget the corporate bond market for a second, but just take the syndicated loan market, collateralized loan obligations, or just syndicated loans. Banks will offer, or banks will agree to lend $400 million to a company, right? They will go out to their hedge fund clients and say, how much are you willing to put in here? They'll get the orders and then they'll underwrite the rest of the loan. So let's say they underwrite 20% of the loan. They actually create $80 million out of thin air, in addition to $320 million of existing money that comes in and funds that loan. So that $80 million that is created out of nothing. And it's really backed by a couple things. One, it's backed by the credit worthiness of the company. And two, the $320 million that of existing capital that's willing to come in and lock their money up with this company. So all of that enables credit extension and just expansion of the system. So how does that system die? I don't see a path to that system dying soon. Maybe Bitcoin, as it grows and rises and becomes more of a dominant currency, and then maybe there's a way to extend credit in a Bitcoin world. I didn't even want to explore that because now we're talking about an altcoin, basically, a credit version of Bitcoin. That's not Bitcoin. And so I potentially see that in the future, but I didn't want to get into that in my book because I thought it would distract from the story that credit and the dollar system, it isn't going anywhere.
The Bitcoin Standard podcast is brought to you by thesafehouse.com, my independent publisher and bookshop, selling the best Bitcoin books in high-quality cloth hardcovers built to last for generations. Most books these days are pretty fiat. They're flimsy and they fall apart quickly, and I did not want that for my books, so I set up the Safe House especially to provide you with beautiful, long-lasting classic cloth hardcovers you can proudly pass down for generations. You can get copies of my 3 books, the Bitcoin Standard, the Fiat Standard, and Principles of Economics, and you can also get copies of Lynn Alden's Broken Money, Parker Lewis's Gradually Then Suddenly, and Matthew Lysiak's Fiat Food, to which I contributed a few chapters. We now offer bulk discounts so you can buy books for yourself and for the friends and family you'd like to learn about Bitcoin. Buy any 2 books for $50, any 5 books or more for $20 per book, and for more than 50 books, it's only $15 per book. Go to thesafehouse.com, the S-A-I-F house.com, where you can get all of these books in high-quality cloth hardcovers, delivered worldwide, and get 10% off for paying with Bitcoin. The Bitcoin Standard podcast is brought to you by the Daylight Computer. I love to work early in the morning and late at night, or in the sun outdoors, but regular computer screens are terrible at these times, and they strain your eyes. For years, I've wanted a paper-like electronic screen on a simple computer I could use to write. I tried several models, but none were very good. Now, finally, Daylight have delivered a fantastic full-function tablet with a paper-like screen that's easy on your eyes and great for outdoor use. I've been using the Daylight computer to write my next book, and it is absolutely fantastic, and it has led me to invest in this company myself. Check out my interview with Anjan Kata in episode 249. And so, in your mind, Bitcoin constitutes an alternative, but an alternative that will likely coexist. So, more like
Yes,
Windows
it's
and Linux. We're always going to have Windows and always going to have Linux.
I think so. And when you think about the two numbers I use in the book to give Bitcoin's future potential some context are 100 trillion in cash assets and 300 trillion in real estate assets. And both of those are somewhat conservative estimates. The real estate one I've seen maybe as much as double that. These are they're not stores of value per se, but they are monetary vehicles. They're ways to store money. That doesn't mean they store value per se, right? They are efforts of people to store value and to store money. And so when people buy real estate as an investment, or they keep money in the bank, or they put money in a money market fund, those are all ways to store money. And Bitcoin, actually, that becomes the market size for Bitcoin. And so in a very simple juxtaposition of stores of value, Bitcoin's $2 trillion has a 200x room to run when you think about the existing ways that people store money.
And what
Or
is
try
your
to,
$100 trillion in cash assets? What does that include?
yeah, so that's a sum of deposits around the world and money market fund vehicles. And it's a rough estimate, but if you look at global M2, I do believe it's around that number.
Yeah.
Yeah, so that's basically what it is. It's deposit liability money and other forms of shadow money that have like money market fund shares, which in the U.S. is 7 trillion. So that 100 trillion in cash assets, it's basically a deposit liability figure.
Yeah. So you wouldn't include bonds in that.
Absolutely not. Bonds are another 100 trillion in assets, but they are. I project that Bitcoin will take money away from the bond asset class. But again, I actually try to separate cash, real estate, bonds, and equities and give each of them an analysis. And I do believe that equity and Bitcoin are a beautiful pair, right? Because one is keeping money and the other is investing in production, right? And those two complement each other. Fixed income, it's in between. It's in between cash and equity, right? And it
Depends on who you
serves as
ask.
a
You could say best of both worlds or worst of both worlds.
sure, yeah,
Yeah.
and so when we think about bonds having a negative real return versus realized inflation, looking back, bonds are definitely a source of inflow for Bitcoin in the future. But I talk about that stuff every day at the Bitcoin layer. That's what we write about. I mean, this is where we live in our analysis, global macro and Bitcoin research and the intersection of them. Fixed income is where I live. That's where it's where I come from. But with Bitcoin age, I wasn't writing a book for the fixed income junkies here. Those people can come to the Bitcoin layer and get all of that. I wanted to write a story about Bitcoin that people can relate to, that they can understand, that explains where Bitcoin comes from without talking about the bond market. And so
Yeah.
the bond market is something that it had to stay away from this book in
It's not
order
going to
to
stay
keep the
away from
story
this
focused.
podcast.
That's why we're here, Saif.
Yeah, no, I'm still going to pick on that. I think it's the way that I would see it. So you said you can't really see how it would be how these credit instruments would be gone in a Bitcoin world. Let me give you maybe a few mechanisms which I would see would drastically reduce the size of this market. And so the first one would be that the once the money stops devaluing, then people can just hold the money itself. And so this, in my mind, eats away a lot of the demand for holding fixed income securities, because ultimately, when people are buying government bonds, effectively they're buying it as if it was gold, as if this was the gold standard. They're buying it similarly to how people bought gold. It's not really meant to make you rich. You don't buy treasuries so that the price of treasuries goes up and you make a significant return on your investments. It's to beat inflation. You're hoping that the payouts that you're going to get on that treasury will outweigh the devaluation of your money from inflation. So it's really inflation that is primarily driving a lot of this demand, because if we lived in a world in which the money appreciated, then people wouldn't even bother take the painful first step of trying to understand what is this thing and how do coupons and yields work, and why should I care and why should I invest in it? Why can't I just hold my cash? And so if you just had a cash that works, you'll immediately undercut and undermine this kind of market. And I think here, you could say, well, look at under the gold standard, we did have a bond market and there were bonds back then, and that is true. But I think bonds there were a lot less significant as a part of the global money supply and the global market than they are now. So when a government would launch a war, they'd issue a bond for that war, and their debt burden was generally lower before the fiat system came about. So the fiat system comes about because you're destroying the value of money. You take away from people the incentive to hold on to the money, and they give them an incentive to hold on to the next best thing, which can offer you a return over the money. And it's also the most liquid market because the government makes that market and the government controls all the banks that are trading in it. So it provides an enormous subsidy for it just because of the monetary manipulation that the government does in money. Well, this would be the first one. Let's discuss this one, and then we could discuss another one later. But how do you see that one playing out?
So it is. So we're on the same page here. The inflation itself is the driver of trying to outpace that inflation, right? Which is accomplished through fixed income securities, or people believe that it is accomplished through fixed income securities. And the reason that I in the book we don't talk about the bond market as much is because actually the bond market is simply a promise to pay those deposits in the future. So if you just understand that the deposit itself is a terrible store of value because of the inflation and those negative real returns that you achieve when you just keep a deposit, a fixed income security is basically a derivative of that deposit. It's a future promise of that deposit. So explaining that the deposit itself is a poor solution to the inflation will hopefully make people understand that the fixed income security, which is simply a promise to pay that deposit in the future, is equally as bad. Especially if the rate doesn't account for that difference.
Well, it's not equally as bad because you're making a little bit of yield, so it's better than putting your cash under the mattress, right?
In a flat yield curve, they're equally as bad. In a yield curve with some steepness to it, you're being compensated. So you're right. It does depend on the shape of the yield curve and how much you're being compensated for the time. Right now, we have a very flat yield curve. So you're getting 4% for 10 years, you're getting 4% for overnights, or you're basically getting a 4 1/3 rate yield for an overnight rate in the repo market or a 10-year yield in the treasury market. And if you are investing in 2-year yields, you're getting even less. So, so right now, there is no reward for lending long, basically, unless you're taking a ton of credit risk, right? If you go out to high yield bonds, 10 years, you're going to get you're going to get several percentage points higher than what you're getting on treasuries. But just because you lend long in treasuries, you're not actually getting much extra yield. So there's a terrible compensation right now in terms of lending long to the treasury. And I want to just mention one thing about the inflation and the incentive to hold money, as we were saying, is if money stops becoming devalued. So if you have people going into Bitcoin out of deposits, then you have less deposits in the system. If you have less deposits in the system, you have less funding source for fixed income securities. If you have things like Bitcoin purchases from governments that are utilizing the credit system itself, you actually get expansion of the credit system just to get out of the exposure to that credit system, which is expansionary to the system. So I think it's a cloudy picture in terms of how Bitcoin affects the expansion of the system. I think it's very cloudy. And you've probably done more writing about this than I have in terms of that contrast in the future. I tried to get into it in the book, and I ended up taking a lot of it out because it was so complicated even just to explore, a future, an unknown future.
Yeah. Yeah. Well, the other mechanism, the other way that I would see it is that as the money stops being terrible and the money can hold on to its value pretty well over time, people start accumulating more and more savings. So savings become more abundant. And so naturally, as something becomes more abundant, its price drops. And so the price of capital continues to decline. And we see this historically. You see that interest rates generally have been declining historically over thousands of years. They go through periods in which we get rises during wars and pandemics and so on. But overall, there is a long-term decline in time in interest rates, which to me signifies a long-term decline in time preference, that human beings become more civilized, more future-oriented. We become more productive, so we have more capital, and then we have more resources. And so we're able to forego larger amounts of our resources, and we're then able to give more of these resources up for investment in the capital market. And so therefore, as our time preference declines, as our savings increase, the cost of borrowing savings declines. And if you continue to extrapolate this, as we continue to get richer, and imagine if in the last century, my favorite thought experiment, which is my next book, The Gold Standard, imagine if in the last century we were still on the gold standard throughout the 20th century. So the trend of the interest rates declining in the 19th century would have continued throughout the 20th century. And it was already at 2.5% at the beginning of the 20th century. So if it continues to decline for the rest of the century, you would expect that by the end of the century, it would have probably been very close to zero. But at a certain point, I think what happens when it drops to that point where it's very close to zero is essentially an enormous abundance of capital. Capital becomes extremely abundant that anybody, well, not anybody, that it is relatively easy for people to secure it. And that if you are trustworthy, if you're credit worthy, then you would be able to secure it at a very low cost because there's a very large number of people willing to give it away. And when you throw in the fact that holding money involves a cost and a risk, and lending it absolves you as the owner of that cost and that risk, and then the borrower is the one responsible and he's the one who has to make the payment. So therefore, you could get to a point where zero becomes an attractive interest rate for people because it saves them on the cost and risk of holding the money. So I would say that in this kind of world, we naturally see the market process that would drive us toward a world in which interest lending is eliminated and replaced with an abundance of capital that is available at 0% for borrowing in case of emergencies and consumption, but available for investment in exchange for equity. And so we'd have a lot more equity investment that since the investor, the cost of capital is very, very low, And so, why would I invest with you, which exposes me to the downside if the upside is very low? I'm going to prefer exposure on the downside and on the upside. So, I would see this as naturally being a process that would drive us toward more and more equity rather than debt. I'm curious what you think.
I like that concept because I think that equity is the perfect complement for Bitcoin. And so it in my world of Bitcoin being the perfect alternative for deposit banking, fixed income securities, equity being the way to invest in a productive future, that the two are the only two asset classes that you'll need. And in that, and in from that lens, we're both speaking the same language, I guess arriving at the conclusion in a different way. If I think that equity and Bitcoin are perfect complements, and you're actually explaining that the presence of better money allows people to forego the lending of that money for very low returns, and therefore they'll seek equity. Um, it's a similar conclusion going through some different steps to arrive at it. But I think that that's this whole concept of savings becoming more abundant and lowering the cost of capital as we all get richer is something that I can see happening as Bitcoin continues to grow and hopefully is owned by large segments of the society as opposed to a small segment of the society.
This podcast is also brought to you by the Bitcoin Way, your professional Bitcoin IT team offering you personalized, secure, and comprehensive solutions for every step along your Bitcoin journey. The Bitcoin Way offer live concierge service to guide you with your Bitcoin cold storage, running your node, privacy best practices, inheritance planning, corporate strategy, and multi-sig solutions. They don't touch your coins, they guide you through the process of acquiring your coins and securing them. If you'd like to make your setup safer and more reliable, book a consult with them and see what they have to suggest. If you want to give someone the gift of Bitcoin, get them this professional service that will ensure they start off knowing exactly how to manage their coins and not lose them. Go to thebitcoinway.com and start Bitcoining more confidently. Yeah. Well, I mean, it can be disheartening when you try and talk to people and try and convince them about this, and you sometimes can reach the conclusion that people are just never going to get it. And I think if people were smarter, a lot more people would have gotten it, and it would have helped it be a lot more distributed at this point. But it saddens me to conclude that unfortunately humanity is going to just force us to have to do it the hard way. And we're just going to have to pump while the vast majority of people are still sitting on the sidelines talking about Bitcoin being an NSA conspiracy or whatever. And we're going to end up with the majority of wealth in Bitcoin one way or the other. It could be through everybody buying Bitcoin, or it could be through everything else collapsing in value against Bitcoin and the Bitcoiners being the only ones left with any appreciable wealth. It seems that, with every day we see more large entities and financial institutions enter, and more convicted long-term holders continue to become more convicted and wanting to hold for longer. And we see more, popular disdain for Bitcoin and more popular rejection of Bitcoin and all kinds of silly narratives about Bitcoin. It brings us closer to the second one, where a lot of people are just not going to make it, sadly.
I think while I tend to agree with you that it could have been much more distributed, it still has brought a lot of people along, and will change the way. Listen, it's changed the entire political sphere in the US, and that's because there's a lot of Bitcoiners here. And so I think that the number of people that are in Bitcoin significantly outweighs the banking cabal. And I think that is the dichotomy that we can watch unfold, and hope to see people that are Bitcoiners in action, and spread their view on the world, their worldview.
Yeah, absolutely. Okay, so what is it that you mentioned that the 6 steps for the dominance of the credit system? Walk us through these.
Yes, so I start in 1913 with the creation of the Federal Reserve. And instead of drawing out the story into the current millennium, I actually believe that the sixth and final step happened after the failure of Bankhauser-Hurstadt in 1974 and the creation of the Basel Accords and the original Basel Concordat in 1975 at the BIS by the G10. The world's largest countries came together and basically said, we are going to backstop the offshore dollar system and lock it in. So the first step, creation of the Federal Reserve, what that does is it gives credit creators, which are the banks, it gives them a backstop. And that backstop is important for the dollar system to keep expanding, because when banks make loans that go bad, they have a bank above them to provide them money in an emergency in order to bridge time between now and a point in the future which they can go back to achieving profitability. Basically, the loss that they would take on the defaulting loan is absolved by the central bank by an increase in credit, right? A growth in the credit system to absolve that individual bank from its potential losses. So that's the first step. And the second and third steps come in the face of the Great Depression and the stock market crash of 1929, which preceded that Great Depression. The institution of deposit insurance and the executive order from Roosevelt that basically made gold illegal. So in the 30s, you had this pair of steps. Deposit insurance, what does that do? It calms the mind about credit. If you don't have to worry about your bank because the government has your back, if that bank goes away, you don't actually feel or see a qualitative difference between deposits and money, which at that time was gold. And so deposit insurance calmed the mind and allow the credit system to expand because people don't have that concern anymore. And then you remove gold by making it illegal. Now, all of a sudden, your deposits that you have insurance on are the only way to store money because you're not even allowed to hold gold. So those second and third steps happened during the 1930s. Now, the fourth and the fifth steps are centered around the Eurodollar system and the creation of an offshore realm in which dollars can be created outside of the United States and outside of any other supervision than the banks themselves and their own leverage ratios. And so when the United States observed this offshore system, and I tell this story in great detail, the system developed in the 50s and the 60s, and in 1960, the Fed became well aware of this. They sent a team to Europe to investigate offshore dollars, and they came back and they said this system of offshore dollars is completely outside of our control, but it's good for the dollar because it will do two things. During that time, remember, dollar credits could still be converted to gold. So if you had an offshore dollar system that was interest bearing, you didn't have the urgency to convert it into gold. You could just hold Eurodollar deposits that were paying interest. And a lot of that interest that Eurodollar banks were paying, it was in excess of what American banks could pay under Regulation Q, which was another 1930s era financial regulation that capped deposit rates in the United States. So New York clients sent their money to London just to get the higher rate because their own bank was prevented from offering them market interest rates. By the way, this is also where money market funds came from, because people wanted to invest in T-bills in a safe and effective way because T-bills were far higher yielding than deposit rates because of Regulation Q. So we had this whole offshore shadow money system develop, and the US went to Europe, investigated it, and said, this is okay. We are okay with this. This may continue. And they gave it this tacit approval. And the proliferation of the dollar system outside of the United States really started to take off from 1960. And of course, the fifth step is the Nixon shock, right? So the fourth step is the Eurodollar. The fifth step, 1973, the Nixon shock, US breaking the convertibility to gold, the Triffin's paradox coming up, there were just too many credits for the amount of gold stock that the US had. They needed to protect it. They shut it down. But the gold shock itself is not the ultimate establishment of the credit system. That happens 2 years later after Herstatt fails. The BIS comes together and says, by the way, when Herstatt failed, the whole system froze worldwide. The only reason it started up again after about 48 hours of no bank wires crossing the oceans or anything, Citibank finally, and JP Morgan finally, Chase at the time, Citibank and Chase finally got wires going again and said, okay, we will actually start to move money around. We feel like the crisis is contained. But there's no government in there, Safe. There's no government. There's just the banks. So the governments actually had to get together in Switzerland and say, we will backstop this system. So a completely non-US phenomenon, this global banking dollar. From 1975, that is the regime under which we live today. And I used to think that the December 2007 swap lines extended from the Fed to the ECB and Swiss National Bank was this grand moment of bailing out the Eurodollar system. But going deeper into the research, I realized that no, that happened over 30 years before 2007, after Herstatt failed. And that 2007 central bank bailout, that was the swap lines to get the Eurodollar system funded again through the Fed, creating, printing dollars for the ECB, and the ECB printing euros and posting those as collateral. That entire system was simply an inevitability when we look at the Herstatt crisis in 1974 and the Concordat in Basel in 1975.
Yeah, people keep saying this idea that this system is entirely outside of the control of the US government and the Federal Reserve. And I have trouble believing that because ultimately the US government affords every single one of those banks access to the SWIFT payment network, and they could put them out of business in a day if they don't like this, if they don't like what this has done. So I think a lot of these people try and present the euro dollar banks as if they're just this free market institution that has emerged, and it's a sustainable organic demand from the market. But they're missing the fact, in my opinion, that it is ultimately all allowed to exist by the Federal Reserve, because the Federal Reserve could stop it from existing. So I don't quite agree that you could say that it is outside of the control of the Federal Reserve, because the Federal Reserve has the power of life and death over all of these banks. And so, therefore, anything that it allows them to do is permitted.
Yeah, and that's why I do tell the story in the 60s of the Fed going over, investigating, and saying okay, because that is a crucial component. I would even go one step further, safe, and say that the banks themselves tell the Fed what to do. And it really is. That's why I believe it's a non-American phenomenon, in that the Fed is really answerable to Basel and European banks in a lot of way. That those banks, when they faced jeopardy in the 70s, got this they got this bailout from the Fed, saying this is okay, we are okay with this, and this is the natural evolution of the dollar system. So that's why I call the dollar the global banking dollar in my book. I want people to understand that this is a dollar that is a banking instrument, not a sovereign instrument. The sovereignty of the US dollar is, I believe, detached from the global banking dollar system and credit expansion, Fed bailouts, and all of that. So there's a lot of. I'll share something with you. I tried to write a couple chapters at the end of this book exploring how to split the dollar between a US sovereign national dollar and this global banking dollar, which currently exists and is issued by the Fed, European banks, US banks, and all of that, and actually try to return the dollar itself to the country away from banks. It ended up being so complicated that I even confused myself in the writing of it. And so I think it's a tough thing to do, to actually describe who controls the dollar. Because I agree with you that the Fed has the kill switch, but I don't agree in terms of, I think that it's the global banks themselves that are pulling the strings on a lot of monetary policy across the world, centered from an academic standpoint, at least in Basel.
Well, I mean, it's also worth remembering the Federal Reserve is a bunch of banks. At the end of the day, it is not an agency of the government. It is a privately owned bank, and so yeah, it's above our pay grades as peasants to know what exactly the power dynamics are there. They're not very transparent about it, because this is primitive pre-Bitcoin technology. They don't have to run things by peer review. They just take decisions, and then the whole world follows along. That's what happens when you have a money printer. But I guess, um, I guess my counter to the thesis of the survivability of all of this goes back to the point that all of this rests on there being a bag holder sucker. There needs to be somebody who holds the bag, and that somebody has always been the saver in all kinds of different forms, and they've always found a way of pillaging the saver, because they've always marketed and sold a way of saying, hey, we can use the saver's money without actually taking it. We can have our cake and eat it. We can take all of the savings of the people in this country, use them to finance something, while also keep the savings available for those people, and nobody will find out somehow magically that we can let people spend their money and also build giant stadiums and hospitals and whatever. So that's obviously failed every single time. It doesn't quite work because opportunity cost is real. But we've, you look at the evolution over time, as you discuss. It's initially, people used to save with gold, then they started saving with the checking account, then we see they're saving with government bonds. And initially, each one of these is offered as a kind of political solution to the problem of how do we make sure people can save. And so when gold didn't work, it's okay, you can just put it in the bank and the bank will offer you an interest. But then banks went crazy in the 1920s and 30s, and then they had to rein in the banks, and so then they had to cap the interest rate on banks. And then with inflation, that becomes a problem because the interest rate eventually stops being able to compensate for the inflation. And so then everybody needs to run into bonds. And that's the global bond bull market that we had from around 1980 to 2020, 40 years of inflows, massive inflows into bonds as people start using them as a saving account. And then that seems to have come to an end in the last 5 years because these bonds seem to be getting wrecked because they overissued them. So, with all of those things, the issue for me is ultimately whatever it is that you use as a method of saving, people are going to find a way of uh, stealing it. There is just always the inflationists, and they're always going to find a way. And like the Wile E. Coyote and the Roadrunner is always going to find a way. And in the fiat system, the the inflationists are Roadrunner. The system is rigged in a way that they get to be Roadrunner and they get to laugh at Wile E. Coyote every single time. The Wile E. Coyote is the poor savers trying to just keep their hard-earned wealth, and then the Roadrunner always finds a way. They always find a way, but where this ability to find a way is what keeps the entire credit market going. And I think if people just have a way of opting out of this, where because the money's not being inflated, we don't need to be playing in all of these sophisticated games, then you take the wind out of the sails of the system. You switch the game so that in the Bitcoin world, the Roadrunner is the saver, and the saver is always one step ahead of the Wile E. Coyote inflationist scammer who's always trying to take the money out. But with Bitcoin, you can just keep the Bitcoin. That's the thing. You just keep the Bitcoin and it appreciates. So you don't need to go and gamble with it. And so therefore, you're not going to be incentivizing the growth of a massive casino whose purpose is somehow to try and offer people the ability to save, which they could just do with physical gold previously.
Yes, Safe, and I should credit you here. I have a couple sentences in the book about Bitcoin helping people avoid the rat race of chasing risky investments. And I do believe that that is one of your catchphrases, one of something that you have helped people understand. So that thesis itself did make it into Bitcoin Age. So thank you for that. I think that that's very important. And you mentioned a word that I use in my class all the time. I use it in my fixed income class in my first lecture when I'm explaining to people what bonds are. It's simply the compensation for inflation. That's what the interest rate is. It's the market saying, this is what I demand to be compensated for today. And so when you talk about the bond bull market ending in 2020, what you're talking about is a skyrocketing of interest rates since 2020, right? It is an expression from the market saying, we do not feel this is enough compensation for inflation today and tomorrow. And so you have entered a secular bear market in bonds, and it's taking a tour around the world. It started in the U.S. Now it's hitting Germany. It's hitting Japan. It's the bond market route is kind of traveling the globe right now, and something that's very fascinating to watch. But Bitcoin being that alternative, it is enough compensation for people. It empowers them because they don't have to take that undue risk. I think that's a crucial component here. It's very empowering technology to not be forced into that risky investment just to keep pace with inflation. So that's the, one of the empowering components of Bitcoin. And then if you have that dynamic, then you have less demand for the alternative compensation, which is fixed income. And that gets back into your point earlier in this show, which is that Bitcoin can suck money out of fixed income because it's not enough compensation for people. And in that way, you reduce the funding availability for those instruments. So then you might decrease the propensity to take on new debt. And so one of my conclusions in the book, and I admit that it could have gone much further, but again, I wanted to tell a story about Bitcoin instead of trying to dream up a future in which it's very unknowable. That one of those hopes for the future is that Bitcoin changes our society's view of borrowing. Can Bitcoin seriously affect how we think about borrowing as a globe and this credit system that we live in? Can it change that? I believe yes, although I don't get into the details of how that might unfold specifically too much. I do have this hope that it will get us to re-examine how we think about the system that we've built around credit.
I hope so too. All right. Well, where can people find your book, and where else can they find you and your work?
Absolutely. The easiest way to buy the book right now is Amazon around the world. So go check it out. There's the Kindle version and the hardcover. But we also are going to be on every platform out there that you're reading ebooks as well. And the book hardcover should be distributed across multiple channels. So thebitcoinlayer.com is where you can find me, links to the book, and everything else that we do. Thebitcoinlayer.com, and my new book is called Bitcoin Age. So please go check it out and let me know what you think of it.
Awesome. Well, thank you so much, Nik, for joining us, and thank you for continuing to write more and more books and spreading the good word about Bitcoin.
Thank you for your leadership, Saif. I appreciate you and your friendship.
Thanks, man. Take care. Bye-bye.